Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
All right.
So jumping right in. Well, first off, we're going to go over a bunch of the different economic indicators that we look at today. At the end, we've got a bunch of different companies that we wanted to look at just to dive into talk to some of our thesis about consolidation and what we see happening in the space.
Yep.
Anything you want to add?
I mean, we'll do it as
All
we
right,
go along.
slide by slide.
Worried about it.
Perfect.
So if we look up and down, it's just because this is where we have all our charts, but we know you're over there. So this first chart is leading economic indicator. As you know, this is an important indicator. We usually break this out. This gives us an indication of what's going on in the economy. The market usually predicts where this indicator is going to be in advance. If you know the market was negative in 2022, in advance, it was showing us that the economy was going down. Now, the interesting thing is the official word is that we're not in a recession. However, we have had 2 quarters of negative GDP that did show that we were. However, we have seen that earnings this quarter have been very good simply because of inflation. So, but what this chart does show is that despite the market going higher, and we are still, and despite interest rates higher, which is very interesting, all the other indicators of which, what are they, another 8, Paul, is that what it is?
There's 10 different indicators total that
so
comprise this.
So there's 8 additional ones that are speaking to how the economy is doing, and you can see it's in the negative, but we haven't been called an official recession at this point in time. However, we argue that there are certain fractions of people who are in a recession.
Yes,
So,
right.
you know, this isn't an even situation, and so there are those
At the top feel it less, those
Yeah.
at the bottom feel it.
where I think it's really taking a big hold, and we would love to poll our clients is those of you who are in retirement and on a fixed income, because certainly Paul and I were discussing it this morning. Our dollars are not going as far as they do for poor Paul has to feed 5 people in his
Every
house.
time I go to the supermarket, it just keeps, the bill just keeps getting bigger and bigger and bigger.
Yeah, I can live on lentils and rice and then, you know, vegetables that I pick from the garden, so I'm
Very
good.
picky 5-year-old and 7-year-old, but
Anyway, so I mean, if you ask this, you know, other people, I would say most people do feel like there's a slowdown, but okay, officially, no.
officially not yet.
But the leading economic indicators do show that we're going in that direction.
So here we have our yield curve. This measures the yield on different lengths of government bonds. So the left side of this chart shows what a 1 month, 2 month, 3 month, and then 1 year, 5 year, 10 year, 30 year.
Can you believe
across
this?
the board.
So this is saying that in the 30 year, you're getting what, 4%? But in a 1 year, not even a 1 month, you're getting 5.4%. This is an inversion. That's typically indicating a recession.
Not just as this inverted, it's inverted in multiple
I know,
places.
it's so
It's such a
bizarre.
wonky chart in, you know, the 15 years that I've been looking at it anyways. I've never seen it look like
I've been
this.
looking at it 15 years. Wow, that means I keep saying I've been in the industry 36 years, but it's 38 now. But the interesting thing that you have to know is that I've never seen a time period where we have an inversion where we didn't have a recession. So if we have these inversions, like sometimes that happen and they're like flashes in the pan, it'll last a month, a few months. But this has been going on for quite a
For a
while,
while,
so.
almost a year now.
Yeah, maybe we're being, gaslit that we're not in a recession, I don't know, something like that. Anyway, so that's, just so you know what that's done for us is it's kept us short.
Mhm.
It's kept us, I
Yeah,
mean, there's
yeah,
no
we know
reason
that.
for extension.
Right, why take on longer, it's called duration risk, or how long of a
Mhm.
bond you want to buy to get paid 4%. 4% or so, when you could, put your money at risk for a much shorter time frame,
Yeah,
get a higher return.
and the other thing is that you have to know too is that, oh my goodness, my phone is ringing. Sorry, everyone, about that. Okay,
Get that out.
yeah. It's not a client. So the other thing that from our perspective, there's been questions about whether we think the Fed is going to continue to raise rates. Paul and I have been contrary to the entire market since 2021.
Yeah,
We knew rates
we were
were
saying they
gonna,
were going up,
yeah,
they're gonna keep raising them,
yeah,
and they
yes.
have so far.
Yeah, and here's the wild card. Actually, we'll get to that chart on inflation. So remind me to talk about energy when we get there, which we will do. But because of what we are seeing in our work, we would say that this inflation trend isn't ending. It has more to do with supply than it does to do with demand. And so, and we just aren't buying the story that it's one and done or two and done.
Yeah, there's a lot of data out there that is contradictory to what the
Yeah.
official.
And I think they're just pushing it. I don't mean to say, I feel like it's the Feds all around the world. I mean, honestly, many of the countries, or not all, but many are tightening.
Mhm.
And, and again, I've questioned this before. We both have said this. Are they trying to break the boat? Are they trying to break the boat? That's the question. Okay, let's keep going.
So this is the Empire Manufacturing Survey that the Federal Reserve of New York does. I think it's every month. Pretty sure there's a monthly gauge that they send this massive survey out to manufacturers throughout the Northeast. That looks at what are their current experiences and what are their future expectations. So the red line shows the future expectations. You can see it's come down significantly since 22, but it's starting to rise back up. Now that's saying that manufacturers are saying, well, I'm hopeful that several months from now, things will improve.
Mhm.
The blue line is really more of, well, what's the actual
What's real?
experience today
Yeah.
on the ground? And you can see that it's lower, right? Especially compared to the longer term average, but it's also extremely volatile. So it is going up and down. This choppiness here
Yeah.
is
I mean, in a real
Right.
condensed time frame, because you can look going back, it's not quite that condensed. Get this for me, Paul. Can you get that thing for me? All right, so yeah, you can see, oh, thank you. So you can see, thanks, Paul. So you can see the chop isn't as significant here. You can see like the condensed of the time frame, just to kind of show you like I don't want to call it schizophrenic, but just kind of odd behavior of.
saying 1 month
Mhm.
might be okay, but then the next month is terrible, but then the next month is decent, and then the next month is not that great. And we're seeing a lot more of that. which is-
And we're still at the zero level, but again, remember, it's directionally what's really important to us, so hopefully this sticks, but even in that little circle that Paul shows, it's a pretty wide, big range. Okay, next one.
This is a similar survey that who is this one? This one comes from the Philadelphia Fed, which again shows future activity or what
What's
the
expected?
respondents expect or hope
Yeah.
for. Based on the data that they're looking at, and then the current activity, which is sort of the as of today. And we're seeing, right, it's trending negative, and then there's this divergence forming too, which happens sometimes, but basically it's one more data point that shows that manufacturing right now is under a lot of pressure.
Yeah.
It's
I mean, one of the things that is going on is China's putting in a lot of stimulation, and we know that we're a major trade partner at this point with China, although tensions are getting, rising. But anyway, so maybe this will change, we'll see. Price of bread.
This chart's always.
Okay.
This chart I've
Yes.
always found this fascinating. since 2003 till to today, the price of bread has actually doubled. I just found that data point to be, wow. When you bring in different pieces.
I don't eat a lot of bread.
Much of the developing world does. It's a huge staple for many parts of the economy. Actually, many wars start because our civilizations collapse because of bread prices. And we've been hearing more and more about inflation coming down, costs coming down. Well, when you look at some of the other things that I should have maybe included, gasoline or utilities, it would show this curve dropping here, but the price of bread hasn't, right?
Yeah.
And other staples haven't.
Yeah, so that's where I think,
Next chart.
does it show it?
Well,
Yeah,
this just
so-
shows inflation in general.
Yeah, so I think when we break out the components, where we've seen the price decrease has been, and you started to see this is in energy. So I don't know, all of you, we did get our electric bills that said, oh, we have a price reprieve right now, but don't expect it in the winter. I mean, that was literally on the Eversource bill, preparing you for the winter. So from our perspective, there's a lot of externalities. Yes, okay, the price of energy has come down, but understand we are taking from the strategic oil reserve, right? So we've been consistently, for the last year, at least the last year, maybe 14, 15 months, been taking from the strategic oil reserve, which is there for emergencies. We've been taking from that. And once we started taking from there, we saw the price of energy, at the pumps come down. What we're seeing though is that the amount of tension that's taking place now across the globe, and actually, as you look at our relations with Saudi Arabia, which is a major supplier to the United States, when we look at the externalities, we get ourselves out of the mainstream media or what have you, and go into what we're seeing. What we see and what we expect is that these prices eventually will begin to firm up and go in the other direction. And I think we've seen a little bit of an increase this summer, but I'm not really sure because I don't really pay close attention.
Gas at the pump has been pretty flat.
It's been flat, okay. Yeah, so overall, just because of what we are seeing in terms of the geopolitical climate, that is of concern. Yeah. And interestingly, too, when we look at oil companies in other countries, so outside the United States, you're actually seeing the price of those stocks firming and going higher, whereas the ones in the United States have been stagnating. Now, what that would suggest to me is that they have a little bit more power. I'm not saying Exxon and Chevron don't have power, but there may be something at play there. Inflation, sorry, we're just going on. Inflation here, you can see it's come down.
So it's come down.
Last, what, 6 months?
And we really like this chart because it shows it measured in 3 different ways, really how they used to measure inflation, and then they, constantly are tweaking these sort of formulas to make it look better, right? But either way, it's come down across the board. And when you drill into the different components of this, it really is energy. That is the main thing
it's
that
a main
has come
thing.
down.
Yeah, if you take out
Shelter, healthcare, all these different things are still rents are
housing
still way
prices,
elevated,
I mean,
right?
One of our theses is that prices will not necessarily soften at this point because of the price of materials
They're
are
still
higher. And we're having a problem with, and I think most of you probably know this, there's not enough laborers, contractors to do the work. So it's getting more expensive. So if we strip that out, you would see that those components are definitely higher. So next. Business diffusion. Yeah.
Yes, so this is another measure of business activity. So this isn't just looking at manufacturers like the other one, it's more just general business activity. And this looks at 3 different areas: the Philadelphia area, New York area, and Texas. So you're getting East Coast and South pretty much. And all of these have trended down, and yes, they are a little volatile over here. Some big spikes, but it's generally much lower than it is on average. It's all negative.
Yeah, what we'd like to see is hopefully a reversal. Oh my gosh, I am so bad at this mousy things. And we'd love to see this kind of activity in that reversal. That would be so rare in a rising rate environment, but hey, you know, anything's possible at this point. Oh, okay, price of rent. Okay, next. Yield curve inversion. This just goes back to show the inversion of the curve and the gray lines there. So let's see if I can do this again. These gray lines.
So
Okay, the gray lines here are recession. So you can see the yield curve. Remember I said that in my 38 years, when an inversion happens, I see recession. Inversion, quick inversion, can happen from time to time.
But the interesting thing is not all three. So this is looking at the 10-year minus the 2-year, the 10-year minus the 3-month, and the 10-year minus the federal funds rate. And so when all three invert, so at least on this chart, it precedes a recession.
Yeah, okay, so yeah, there is
If just one reverts,
Yeah.
might not mean that we're actually going through a
So you can see here, and we had it, and understand that interest rates are a leading indicator. Like the chart we showed you at the beginning, this is actually factored in. So here we are, no recession. So, and that might have, you know, the only thing I can think here is that has something to do with pricing power at the company's level, you know. So profitability is still very high because they're doing a good job balancing us.
Yeah, it's doing a great job. Bottom line is still. So into some of our risk measures, credit default swaps. Again, this is just a simple measure to look at the price of insurance against a company going bankrupt. When these spreads widen, it basically says that the chance of bankruptcy goes up higher.
So this is good.
They've generally been flat. This looks at sort of an aggregate of high yield and investment grade and then emerging markets.
Yeah, this is good.
They're all generally pretty flat.
I like this.
This isn't concerning, so that's good.
This is a good chart.
Right, this is by individual companies. So instead of like investment grade, this looks at a whole bunch of individual companies, and yes, they have risen for a group, but they have yet to hit any new highs. They've been elevated for a while for some of these, but again, we always look at the velocity of change, rate of change, and these have sort of flattened. Like yes, they've gone up, but they've sort of stayed.
Yeah, so one of the things that you need to know, right? We don't look at any one indicator in a vacuum, right? We look at them all. So this, thankfully, this isn't getting worse at this point in time. And remember, this and credit spreads were the two things that helped in the tech bubble, helped in the financial crisis. So that's good. Do we have the credit spreads? I don't think we do this one, right?
No.
Bond spreads, just risk management.
Yeah.
Yeah, because we have the credit spreads here, so these aren't elevating. That's good.
Right.
So that is the most important indicator because that's real-time data, real trades.
Right.
So,
And this generally looks
okay.
Yeah.
Okay. So that's the risk of default at the corporate level is low. And then
And then this just looks at the triple B industries. The only industry that is under some stress is financials.
Yeah, so
which is the orange line.
So this is important because you know the first spike you see in that orange line was Silicon Valley Bank, and then it came down, and then now it's going back in this direction. We don't want to see this ticking up. That would be cause for concern. So you can see that Paul might dice and slice these a lot of different ways. We're looking at the company level, we're looking at the industry level, and then we also look at it at the government level. Okay, now there's a reason for that, because if we own stocks, understand this. So I'll go in the tech bubble, I owned Enron and WorldCom. This very indicator got us out of those stocks before we had any losses. So this is why, so even if we don't own the bond of the company, we're looking at this indicator.
Right. One of these, yes.
Reverse
repo, again, this is really a sign of bank health. Well, I guess smaller sized banks health. If they're tapping into this reverse repo, it says they're having problems either sourcing liquidity or just having funds available. We've seen the usage of this tool by the Fed spike. Obviously, nobody was using it back.
So that was Silicon Valley Bank.
And then all of a sudden, and now it's something like 2 trillion. That's the amount.
That's a substantial amount.
It's huge.
It's still elevated levels, and something that I want you to understand. Want you to understand something about this. It's still at elevated levels. Okay, so this is definitely a problem. We don't want to see elevated levels. What we don't want to see is a reverse in the other direction. And one of the things you have to remember, the economy, in breath, out breath, in breath, out breath. That's how all of these measurements go.
Everything is
In
cyclical.
breath, out breath. Okay, so in this case, this is the out breath. It's relaxing. It's relaxing.
Ease here, but again, it's still in the trillions.
It's still in the trillions. We want to see it back to
Yeah.
where it was, and then we know we're out of the woods. So again, this is the out breath. It's just relaxing at the moment. We are hopeful that this will go in the other direction, except Paul, did we pull in the disintermediation of the banks? Okay, so the last we knew is there was still a disintermediation from the banks. In other words, people taking money out of their bank accounts and putting them into money markets. Now, reasons for this is when you put your money in the bank, know that they're taking that money and putting it in mortgages, commercial mortgages, and other C&I, any other type of investments, okay, loans. And also they have a portfolio. So what people don't want is to take that risk, right? Because right now, certainly commercial real estate is not doing well across the country. It's doing really bad, actually. I don't think we put that chart in here. But then what people are now doing is saying, I don't want my money in a bank. I want my money in a money market. Okay, great, but make sure it's a prime money market.
Yeah.
Prime money market.
Government
backed.
backed money market.
Yeah, dollar and dollar.
So I know in previous previous webinars, I had said that there was prime and not prime. It's actually government backed and prime. So
Okay.
prime money markets are, they use all sorts of crazy overnight paper, commercial things, right? And then government backed only use treasuries or government backed securities that have the guarantee of government behind them. So take note.
Take note. Make sure it's backed by treasuries, please. Okay. Especially it's a money market you want to save.
Yeah.
Market valuations. Oh yeah. So here's the valuations currently in the market. I don't think this is a surprise. This is mostly, we're seeing this in technology, and it's very few that have run higher. Apple, Google, not even Google, Apple, Microsoft.
It's like that's
NVIDIA.
a small handful have
You have hit a new 50.
pulled everything or pulled the indices higher, but
Yeah.
the rest have. I just read something a week or two ago. It said if you took the top, I think the 5 largest companies out of the S&P 500, it would be flat.
Flat on the year. 5 top companies in 500, pull them out, and the market's flat.
One of the things we always want to see is broad participation,
Yeah.
because that's a really good sign of health, where if the
Absolutely.
rising tide actually does lift
Mhm.
all boats. That says that, hey, things might actually be firing
Exactly.
on all cylinders with the economy and everyone's in good spirits. But when only a few go and the rest don't, it definitely adds
Yeah.
concern.
Yeah. Okay. Next one. I think we have. Oh, we have one more. Oh,
There's
we
a
just-
bunch of companies.
Yeah, so there's a bunch of companies that Paul just and I, we're always.
As we're going through our charts.
We're going through the charts and working together, just looking at the fundamentals of companies. We just wanted to point out what that first line of numbers you see there is revenue growth. If you want to point down, can you get it? Okay, he's going to try to highlight this. But while he's doing that, you can see that this is IBM and there's the revenue growth. Okay, so 55, 57 million, 60 million. Okay, so let's keep going. Now let's take a look at Apple. Oh, that's okay, because it's still coming. Look at Apple compared to IBM, right? I mean, this is-
394 billion.
for those of us, like for those of those of you who are, I don't know, 30, been in the market 30 years, this is incredible, right? This is way overtaken.
Not even 10 years ago.
Not even 10 years.
182 to
Yeah.
394.
This is
It
crazy.
speaks to our point too, that consolidation is happening at a massive
Yeah.
scale with these large companies.
Yeah, and
Mega cap
that is one of our themes. We call it the bugs. there's an acronym there. We
Talk to us later.
big, ugly, anyway, it's the bugs, and the big is getting bigger. And if you remember, this is one of our themes, it's been one of our themes for well over a decade. Big is getting bigger, and you're seeing this here, absolutely. So here's Apple, let's see, do we have Microsoft in here? Yeah, Microsoft, another one, like, look at this, these revenue numbers.
It's insane.
Yeah, let's keep going, so 198 million, so next, Procter and Gamble, so, you know,
Billion.
80, but that's not even, like, that's small compared to
Yeah.
these technology companies. Next one, Paul,
Oh, look at
Amazon, this is crazy,
513.
that's insane in the
Wow.
membrane, anyway, so the next,
Google,
Google,
282
Yeah.
billion.
and then like,
Exxon,
for there's
13.
did we have one more, and we did Visa, 29. So you can see these technology companies are printing money left and right.
McDonald's 23.
McDonald's, you know, I mean, like.
And Walmart.
Yeah, no,
Jeez,
Walmart, yeah.
611 billion.
I mean, that's
It's
crazy.
insane how large these companies are.
Yeah. So this is what's going on in the world. We find this data just intriguing, but one of the things that we do look at for your portfolios is we are always interested in revenue growth,
Yeah.
not interested in cost containment. You know, cost containment to me means that the company's pretty much, you know, not doing great, has to contain their costs in order to make their margins look better. We want to see revenue growth. That's
Consistent
really
revenue growth
consistent
year
revenue
over
growth.
year.
Yeah, yeah, because then that tells us that there's demand for that product and they're not just an old dinosaur, which IBM is a perfect example of an old dinosaur, honestly. Yeah. Yeah, I mean, it's there somewhere. I mean, you can go back.
Yeah, so you can
look at the
see
revenue growth. Look at how
the change.
it is.
Yes, it's actually gone down.
Yeah, it's going down.
2014 to.
So this company, now listen, if we owned it, it's because of the dividend.
Mhm.
Okay, and we know that the company's not going anywhere and they have a, well, you don't know, we don't know.
Wouldn't buy this for growth. That's the.
No.
Yeah.
Okay, so anyway, are there questions? Did we have questions?
The last thing I think we did want to mention too was our dollar theme.
Ah,
Saw
yeah.
this headline
Yeah,
recently
yeah.
about the BRICS confirming
Yeah.
that they are actually going to create a gold-backed currency. It sounds like the official announcement will come out sometime in August.
Yeah, I think that's what their meeting is called.
Yep, that's
Yeah.
when the next major meeting is. And why this is important to just pay attention to is that they're finding new ways to settle their trade without using the US dollar.
Yeah, so,
While you could argue that, you know, a lot of the BRICS countries probably don't trust each other that much, they also are concerned about trusting the US because as they've seen, the US can put sanctions on your country or straight up freeze you out from participating in the SWIFT network and these different ways to facilitate.
which has happened.
Mhm.
So, but this is, you know, there was always, everything gets foreshadowed. So the BRICS came together and created their own bank, like equivalent to the World Bank, what, in 4 years ago, something like that, 3-4 years ago. And now you can see, like we said, one of our themes is the dollar will not be the dominant player. If they do indeed create this has a lot of implications.
Definitely.
And so, anyway, do we have questions?
All right.
Did some come in, Paul? Did we have some?
We had a question around, do you think the Fed will raise rates again? Yes, we do. Will they raise at this next meeting? I mean, I suppose that's just guessing, but the data we're looking at says they're not gonna stop. They telegraphed that they're not gonna stop. They might pause for a little while longer, but I got a feeling they're gonna raise. You think so?
I do too.
Mhm.
Yeah.
Mhm.
Yep.
Yeah, and then the other question, I think was just around views on a possible
possible
recession.
Yeah,
Mhm.
I think we covered that.
Right.
Any other questions? You can raise your hand or you can put it in the chat box.
Got it. Open right on our screen, so any questions, feel free to let
Okay,
us know.
all right,
And if not, or you think of something later,
call us.
you have our number, you've got our emails, give us
Yeah,
a
call
call,
us.
shoot us an email. We're always here. We love talking about this stuff.
This is fun.
Yeah,
I
we
like
have a good
this.
time.
All right, anyway, thank you, everyone.
All right, thank you.
Take care.